It's time for this week's Lucia Capital Group weekly video. I'm Rick Plum. A couple of weeks ago, I gave you some stats that show personal spending tends to go down over the long-term course of retirement. This is especially true as we get into our 80s, and even more so if we're lucky enough to make it into our 90s and beyond. Again, that's over the longer term, but in the short term, usually right after we retire, spending may actually go up a little, or a lot. Once you quit the workforce, you may feel the need to do the things that you've always wanted to do once you had the time, the money, and the freedom to make it happen. I'm sure you've thought about it from time to time, whether it's traveling to exotic places, or maybe training for a marathon while you're still able to move around gracefully, or even just staying in town to enjoy the comforts of family. When the rigors of work are out of the way, it's a lot easier to plan. That's why retirement can be the perfect opportunity to take another look at what you'd like to do and figure out how to potentially make it happen. Of course, as much fun as all that is, you've got to be able to afford to actually do it. The last thing you want to do is run out of money just as you start enjoying what could be the best part of your entire life. You've just retired. You're still relatively young, healthy, and able, and you have plans that may require you to take more income. But if you're withdrawing money from your portfolio to fund your lifestyle, and it's coming from volatile assets that go up and down with the stock market, you could be asking for major trouble. Research has shown that large distributions from portfolios that are going down in value from market declines can cause your assets to become depleted faster than expected, and they may never recover. This is what we call sequence of return risk. The market may average 8 or 9%, but it doesn't do that in a straight line. It goes up and down, and if you start pulling money out of your portfolio during those down times, that can be a problem. So you need to have a retirement strategy that takes these risks into consideration and aims to address them. You don't want to have to cancel your vacation or tell your grandkids you can't visit for Christmas simply because the markets took a bad turn and you don't have the money, or you don't want to sell assets when the portfolio is down. You want the source of your income to be there, ready for you, whether the market goes up, down, sideways, exactly like they do all the time. It's why we've used the bucket strategy for all these years. Placing a segment of your portfolio into lower volatility assets to fund your short-term income needs will potentially protect you from the risk of outliving your retirement savings. More importantly, it may allow you to do the things you've been planning to do once you left the workforce. And really, that's what enjoying your retirement is all about. If you need help or more information on how the strategy works, just give us a call. As always, we're here to help.